Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experiences from 23 years in the game, so you skip the mistakes we made and go straight to property investment success. And today, Jez, we're going to be discussing first steps towards
financial freedom. Yeah, and this is a big one for you, isn't it? This is down your alley.
Cash flows, spreadsheets. I love it. There won't be too many there won't be any spreadsheets today, but you know I love a good spreadsheet.
Yeah, you'll create a spreadsheet for anything.
Cash flows, you have to.
What are we having for lunch, Damo? Oh, let me just whip out a spreadsheet.
Oh, I'm not that bad. So, as you know, I'm really big on this. For me, first step is money management, which we'll sort of discuss. But I guess, what is financial freedom and why do we want it?
Yeah, so I guess financial freedom, when I think of the term, I'm thinking don't have to work. So I've got some assets that are generating income for me that replace my salary, so I don't have to get up and go to work in the morning.
So it's pretty much money earned without little or no effort at all.
Yeah.
Is the definition of sort of passive income.
That's what they call it, passive income. Yeah.
Because the ideal scenario is you never want to have to rely on your employment, really.
So give us some examples of passive income.
Oh, well, so I'd say like maybe money in the bank. So interest that you're earning, it could be like, rental income from your property portfolio. So let's say $30,000 rents coming in and you got 20,000 expenses, 10,000's left over in the year. What's that, roughly about $200 a week, give or take? So that's just money coming in without little or no effort. The other most probably one in Australia would be most probably like shares. You've got a share portfolio or some index funds that are giving you dividends, which is profits that come from these companies, and it's paid directly to your bank account, or you can reinvest it. They're sort of the main ones, but that's what it is pretty much. No effort, money coming in. And why do we want it, Jez?
Well, so you don't have to work, I guess.
Well, it'll cover your living expenses, but you can do what you want, what you love, like your passion is. I remember for me, I'm still working on that passive income goal, and I moved away from accounting. I did accounting for a very long time, didn't love it, and I knew I wanted to just get out of that industry. And I'm very fortunate that it's given me those skills in numbers and spreadsheet and analysis. But for me, I took a significant cut to move to Melbourne, join a company, and learn my craft. And I just think options. It was hard making that decision because you're leaving pretty much everything behind and starting fresh, but I don't regret it one bit. I was very nervous when I was driving, packed up everything driving to Melbourne, but best thing I ever did.
Right, yeah.
Hobbies, do things that you love. I think time's your biggest asset. I think we forget that a lot of the time. We get into that grind of just work, and you need to find that happy median. I think now, really, don't you? Like you will find it and do the things that you enjoy. And like I said, time, it's just so hard to find it, isn't it?
Yeah, time's the most precious asset, isn't it?
And everyone wants your attention. Like with the phones is most probably a big one. Me, I always have these notifications off.
Switched off.
A lot of the time, but I'm very much on getting in that sort of that zone of always being focused and present in whatever I'm doing. So I think that passive income is what we're sort of working towards. And I think you mentioned it before. You can ask me this question.
Yeah, so you did mention shares and rental income, but surely there are more options than that.
Yeah, so the first one I'd say is like, savings account's the first one. So when you're building up your deposit, you've got money in the bank and you earn interest. And you have to pay tax on that interest because it's taxable income. So at the end of the year, you do your tax return. Rental income, so early on, typically you're negatively geared. So you're in a deficit every week or every month or every year. But eventually your portfolio is going to be generating more income than expenses. You have to pay tax on that. There's nothing wrong with that. But the idea is that's generating you income without doing anything. Shares, so dividends I mentioned. Index funds is something that I've leaned towards a lot more these days. So I do have properties. I have dabbled in the whole crypto thing. I think I've tried everything. It's just that was my risk profile. Now I'm a lot more keep it simple and index funds, low fees. I like to just have a couple diversified there to spread those assets out. and have that liquidity. So that would be another thing where they just pay you maybe every quarter or every 6 months. Specific shares. So let's say I just buy CBA as an example. They might just pay a dividend and that's it. So some companies pay more, some less. Some don't pay any dividends at all, but they're more focused on growing the business. So putting that money back in and growing. And then later on, they might distribute dividends. But if you've got growth, then you can always sell down. If you've got a business, you've got profit at the end of the year after all your expenses. That's another form of dividends that you can, passive income. So what have we covered? Savings, rental income, shares, managed funds, index funds, business profit. Look, things like maybe like Uber car share or something like that. But that's more most probably you are a bit active because you're putting your car there. And then I actually had a client once that had a vending machine. So he invested in a vending machine and the yield was quite good on that. I thought about it. I'm like, maybe I should get it. I had enough on my plate though, so I left it.
Yeah, I've heard of parking spaces, ATM machines.
Yeah.
Yeah, where you could yogurt bar.
I think a bit more technical is crypto. Like I sort of stay out of that a little bit, but you can sort of do staking and that can generate some sort of, that sort of gives you more and more this cryptocurrency, but I would sort of stay away from that. It's just very, very risky for me. So I like to sort of keep it within, I think, property shares and like index funds are my main thing.
And what about superannuation?
Yeah, so a lot of the time, a lot of people have no idea about their super. So I always urge, talk to a financial planner, review your insurances as a form of like, think of it as like the goalkeeper in the soccer team. It's like your last defense if things go wrong. Having insurances in place is really important. But typically super's invested in like managed funds. So it's good to do a bit of a dive into where your money's actually allocated because it is your money. And based on like myself, for example, I can access that at 60 if I decided to retire and take that as either a tax-free pension or a lump sum. But it's normally invested in like the stock market. There are sometimes you can set up like maybe self-managed super funds with a financial planner that you need to get advice from them to discuss, but I have seen clients do that where ideally you want to have maybe 200,000 to 300,000 in there if you are thinking about buying maybe a property like within a self-managed super fund, but you can't access that for a very long time. So it is quite passive. Your employer pays 11%. You can make your own contributions, but that's sort of ticking away in the background, but it still is your money.
You know, one of the triggers that got me into property investing, I think it's every 6 months my super fund manager would send me an update. Dear Mr. Shepherd, here's how much of your money we've lost. Here's how much we've charged you for it. Have a nice day.
I highly recommend that you always, anyone listening, does a sense check insurances and how their investments are going and is it beating maybe like an index fund. I've got a wrap set up now, which is a bit more technical, but I just go in basic index funds with low fees. But maybe self-managed super fund a little bit later on. But like I said, super's more of a tax effective environment. I know a lot of people contribute, but I rather have all the money in my own name now, invest it because I've got that flexibility. I don't want to wait till 60 because I feel like I can get a better return with my money now. And I want to do the things that I enjoy now too. So I like having that cash there.
Yeah, all right. So what sort of target should we be aiming for? How do you set your passive income target for property investing, for example?
Yeah, I think this can be a whole series, can't it? And maybe like later on when we have a bit more spare time, we can do maybe some spreadsheets and analysis, but it's different for everyone. And from my experience, clients coming through, they've got no idea. They come in, I'm like, well, what's your target? 100,000, 130,000. I read a book, listened to something on YouTube. You know, they just think it's that easy, and it is difficult. It is hard work. And I think that target, like I said, the way to work it out now is how much do you need to fund your current lifestyle? So if you're renting, maybe all your rent and all your expenses, you total that up. That would be one way. So let's say it's 50,000 in the year. Well, that's your target to hit because you want to replace all your expenses. And that might change family, private schooling, but that'll eventually drop out when you head to retirement. The kids have mostly left home and all those, it's all in the past. Like
all that education expenses.
Yeah, the expenses. So
and,
it's like the expenses increase for a period of time when the kids, the private school, and then it drops again. But a good way to work it out is what am I currently spending? But then you might want a bigger holiday budget in the future. You might want to build your portfolio, so you need more cash now, more savings to try and accumulate, and you just have to find that balance. But like I said, I think it's different for everyone. I'll bring up actually on the screen, so I do have visual aids, so anyone can just while listening to the podcast, they can look at the visuals on the screen or on the mobile. But there's a website here. I can leave the link also in the description of the episode, but it's like a retirement standard. I used to bring this up a lot, and I still do, but it's a bit of a benchmark. So for example, it says 65 here, but let's just say for a comfortable lifestyle for a single, in today's dollars, it's 51,000. Now you have to obviously add inflation if you're retiring in 10, 15, 20 years time. But as of today, you could work out what are my current expenses, and it's about 51,000 for a single for a comfortable retirement, and that includes, like I think, an overseas holiday every couple of years, or you've got 72,000 for a couple.
So this is based on right now. If I wanted to retire comfortably, I need, if I'm on my own, $51,000 of passive income to make ends meet.
Net passive income, and this number takes away either your owner-occupier that you're living in, so it's pretty much saying that's already taken care of or paid off, or if you're renting, it doesn't take that number into account. So it only takes into account your lifestyle and any bills that you might have. Moving down, and then I think there's 85 here. It's a little bit lower because you're not spending as much. So that's a bit of a benchmark, but I just say look at your maybe total, like what your expenses are today to sort of come up with a number. And like I said, you got your current situation, and then things might change.
Yeah, I imagine like if you've got a young client, a couple, they're planning on having kids. Do kids radically change the plan?
Well, it's taking more of your surplus out, isn't it? So let's say you've got, your total income minus all your expenses. Let's just say $5,000 a month at the moment. Okay, great. We've got $5,000 a month. Then the kids come, time off work, maybe go back to 3 days a week. You're down to maybe $1,000 surplus. So you need to be careful if you are thinking of accumulating and starting a family and buying your owner occupier. You've got your cash buffers in place, money in an offset account, or just money for an emergency. So that's why that passive income is important, but I think having a buffer is really crucial. And I guess if you're looking at a number, just as a basic principle, you could always go, let's say 50,000's the benchmark. I'll bring this up on the screen. So you go 50,000 divided by, let's just say 4%.
That's the return on the investment to, right, okay. Yeah, so you're assuming that you're going to get net of 4%, whatever your investment is, and you need 50,000.
We'll make it simple. Let's just say you've got $1 million in income-producing assets. So that could be your current investment portfolio minus your debt, maybe any shares you might have. So you want that net number. Like, what's your net asset base? So if you've got, let's say, $1 million property portfolio, but your debt is 900,000, your asset base is 100, like it's 100,000, your equity. So you need that portfolio to grow, one, for the values to grow of those properties, but also the rent.
Yeah, okay.
So if we just use $1 million,
target.
Let's just say you use $1 million and we just times it by, let's say, 4% rental yield as an example, that's 40,000, but that's gross, and then you have to pay tax on that. So we sort of have to play around with those numbers depending on your circumstances, but that's a bit of a rule of thumb. You could use 4% because you have to think shares, every different index fund or company yields differently. So you might get, for one index fund, it might give you like a 3% like income. Another one might give you 5%. So it just depends on your asset allocation. And then with your properties, you might have a property that yields 6% per annum compared to a property that yields 3%. So it's all different, but you want to bundle it together to get an idea of that passive income that's being generated.
So this target that you just came up with there, that $1 million, for example, let's say I'm working towards my $1 million passive, $1 million net asset, which is going to give me net yield of, say, 4%. over a period of time, for me to get there, inflation is going to eat away at that 50,000. So yeah, it sounds complicated, the calculation.
We're going to need more. Like that $1 million today is going to be maybe $2 million in 10 or 15 or 20 years' time. So it's really in depth, and we won't go in it today. It's just good to understand that when you think of a number, just be wary of listening to these things. By the age of 30, I've got $100,000 passive income in my time, like working with over 7 years with clients. No one could really do it just starting out, everyday Aussies, unless they've got a business generating a lot of money or they've got a handout in some capacity.
What do you mean by handout?
Oh, let's just say big gift, or as an example, or parents have helped out.
Yeah, okay.
There are instances if you started really early, like at 18, 19, 20, and you've been able to accumulate quickly, maybe sell down a property, you could get there. But I always just say that make sure you enjoy your life, and then also slowly trap that surplus over time.
Yeah.
Find that balance.
So that surplus, what sort of tips can you offer for a realistic passive income target based on like an individual's specific goals?
Starting out, get your money management in order. That's, I think, the biggest gap that I see, because that really just sort of sets and compounds. It's like with anything, your health or your sleep or whatever it might be. If you can put those good practices in place, I would say track it maybe every month. If you're not good with your money, work out, okay, this is my total income. This is my total expenses every month, including maybe your holidays you could provision for. Okay, I should have $3,000 left over every month. Is your account growing by $3,000 per month? Are you checking that number per month? So let's say you start at 10,000, and then next month in March it's going to be 13,000, and then 16,000. Just make sure that you're tracking that your surplus and savings are growing, because then it's like, okay, I've got that surplus, and now I can go and invest.
Right. Okay, but let's say someone's just making ends meet. They still have super building, don't they?
They've got their super, or let's say they're living in their own home. Don't be discouraged, because your property is still growing in value and your super is still growing. The challenge is you don't have access to your super till you're 60 with current legislation. So if you can try and get that portfolio earlier and hold it, that's just going to grow over time. And like when you do buy that property, as I mentioned, like your surplus of $3,000 a month might go down to $1,000, but that's okay. I don't mind having a bit of negative gearing, because I've got this, I'm controlling a $500,000 property.
So it comes down to, it sounds like being very organised with your cash flow. I
would say just try and automate things. So do you automate your finances?
Some of them.
Honest. So normally I would like to have everything going into one offset. All the, like, let's say rental income, dividends, employment income hits the one account. And then normally what I would do is have everything separated for just my bills. Think of it from an accounting term, fixed bills. So it could be like electricity, could be rent, could be water, all those things that you need to survive.
Regular sort of things, yeah.
And then you've got your variable to another account, your variable expenses. So it could be dining out, vino, whatever it might be, your luxuries, your coffees.
Holidays?
I actually separate holidays. I've got another account for that, just to go every month, just some provisioning for that. So think of it as you've got your main offset where all your income comes in. I've got my bills account, my variable account, my holiday provision, and just the bills account. And then I'll work out, okay, well, how much needs to go in that bills account every month? And on the 30th, I'm very meticulous with this, but on the 30th, I've got an automatic transfer that goes in the bills, and it counts for all my bills for the month. So think of it as topping up, and then it'll dwindle down, and then it'll top up again.
Right, each month.
Variable is just consistent. I used to do it on a weekly basis, but now I sort of do it every month just to keep it a little bit easier. And then I've got all my loans coming out on the 30th. So at the end of the month, it's really easy. I just need to track my main offset account number to see what my surplus is. Because if everything's automated, there shouldn't be any slippage in my primary offset. Yeah. So if I know my surplus is 3,000, well, I've got everything automated. And look, if my income grows or my expenses change, I would change that up a little bit. But like for example, if my income goes up, it doesn't mean that I'm going to portion more to my bills. I'll keep my bills the same, and it just means I've got more surplus. Because a lot of the time, I've actually seen people use a percentage system. like, let's say 10% of my income is going to go straight to savings, I prefer to look at it as, all right, well, what are all my bills? What's all my luxuries? What's my holiday provision? And what's left over? Instead of using, 20% should go here, 30%. Because if you have that income increase, well, I want to trap that extra surplus and put it into my offset.
Right. So you keep your expenses fixed rather than, okay, that makes sense, rather than having a percentage system.
And I'll normally review it annually anyway, but I do like to provision for the holiday too, because you don't want that lump sum coming out once a year because you're like, oh, where did that money go? So, I think that's most probably some of the tips just starting out towards building your passive income.
So let's say we've got a target in mind and we're trying to reach this level of investment where we've got enough passive income to retire on. I was quite aggressive with this when I started out investing in real estate. How do you balance that sort of level of aggression with risk?
You could look. Everyone's different. Like you just went property, didn't you?
Originally it was shares until I realised I didn't know what I was doing, and then I switched to property. Yeah.
So I've dabbled everywhere. At the moment, I've got like around 85% towards property. So think of it as you got your property portfolio minus your debt. What does that number equal, as an example? And then you might have like, I've got shares, a little bit of crypto, and cash. So I've got like an asset allocation, but 85% of my asset allocation is towards property, and I'm okay with that. I just like the stability of the Australian property market. And that's how I balance it out. So it's sort of spread out everywhere. I might look more to go into index funds as I'm still growing the portfolio, or maybe another property. But for me, it's about asset allocation and then also having a buffer. So it might be, let's say I need 50,000. I know I spend 50,000 a year. I might want to keep 50,000 in the offset account as a year buffer. Let's say I'm not working or I want to take a year off. That just gives me a little bit of, I can breathe.
Yeah, safety net. Yeah.
You need the safety net. The last thing you want to do is go buy a property and you've got a couple grand in the bank, but then you want to go overseas, or you want to start a family, or you want to go buy your owner occupier, or you need a new car because it's broken down.
There's no room to move.
So I think, like normally the asset base, I've got a reminder in my Microsoft Outlook that I'll check maybe every 3 to 6 months. I'll update that, just set a reminder, update asset balance.
Right, yeah, because I was going to ask you, do you have to keep, once you've got this set up, is it set and forget, or do you need to monitor and tweak things?
With life so busy, I just you put it in the calendar and I forget it and have it recurring, and then I'll just double check it. Because I used to be like I would actually track. There was a period that I tracked my money management for 3 years 3 years daily. I had an app and then I'd export it. But one thing I noticed is it didn't stop me from overspending because I didn't have those automations happening. I would have this big account that, let's say you've got 30,000 in a bank account and you're just tapping, tap, tap, tap. There's nothing to limit your spending.
Right.
And you need that.
So what advice would you give for, say, beginners to set their initial like passive income target?
Yeah, set a good budget. I think focus on the surplus. Always think about what's coming up in the future, like family and all of that. Set a realistic target. I wouldn't get so big on it needs to be 50,000 per annum. I think you just want to optimize what you're doing now, like what you're optimizing your money management and optimize the best return you can get over your investments, be it property, index funds, shares, whatever it might be. That's all about what we want with our surplus, the highest return on our money for the least amount of risk.
Yeah, good one.
Okay, so, and I'd say don't stress. Don't stress too much about it. I know initially you might need to cut back on things, but the things that you find joy in, there's nothing wrong with spending money. If it is a coffee a day or whatever it might be, then do it.
What are some of the things that you've noticed with all of your clients as having the biggest impact on their cash flow?
I think the money management. Is that
Just
what you mean?
The management. Yeah, I'm thinking individual cases like, is it have they overspent on a holiday? Is it cars, or what are some of the real killers to cash flow?
I think the cars, when you're building your portfolio, getting into these lease payments with vehicles because you think they're really tax effective, like you need to talk to obviously your accountant and your mortgage broker about it, but that does hinder your cash flow and it cripples your borrowing capacity. So I think cars is most probably the big one. It's just that sacrifice. Like if you're building a property portfolio, do you need that fancy car as an example? Like, or can you buy a secondhand car? Like how important is purchasing that property for you? Like you might max out your leverage and then you might decide, okay, as a present to myself, I've done really well. I'm going to go buy my car after I buy that property. But I think that's most probably that not having that money management in place is where a lot of people fall over, because otherwise they're just guessing. They think they can go to a broker, go buy an investment property and that's it, without having any money management in place. And I'm massive on it.
It's funny, on the way here, I was passed by a ute, one of those big utes, and I didn't actually know this, but Mercedes build utes. And I thought, hang on a sec, here's a brand we associate with luxury cars. Have utes now become a luxury car?
Well, they're expensive now, I think. A lot of utes these days are not cheap at all.
I just thought, well, there's a good example of our problem with inflation, our problem with spending on useless things, on overpricing things for what they actually are.
I think it's just impulse buying. Like I think at the end of the day, you can't change anyone. You have to make that change for yourself, and you need to find that. So it's like the way I look at it is, I want an easier future. Like, and I'm happy to sacrifice things now. Look, I've got everything I need. Like, I'm really happy with my life, but it's more the fact that I still do the things that I enjoy, go on holidays, and it's just having that portfolio earlier so it can grow. The last thing you want to do is go buy an expensive car and then, I've just spent 50 grand on a car. That was your deposit for an investment property. That property will bring you the car. Like 1 year of capital growth, of 50,000 growth in a property can get you that car.
Yeah, it's amazing, isn't it? Yet that car is going to drain your bank balance because of insurance, petrol, maintenance, and of course depreciation.
So my tips for beginners: budget, get a budget in place, have those automations happening, and still enjoy a little bit of life.
All right. So wrapping up, what would be the? Oh, have you got more points?
I do. Yeah, I think. How about? I guess some misconceptions I've seen, or with a lot of meetings that have happened. Like I said at the start of this episode, a lot of numbers get thrown around. $100,000 by the age of 30 or 40, and that is very difficult to do. What a lot of people don't realise is how is debt paid down on your portfolio normally a lot of the time, do you think?
Well, if you had multiple properties, you'd probably sell a portion, or...
Now, it depends if you want to... Yeah, go ahead.
Super?
Super's the main one. So normally, if you want to retire, let's say by 40, 45, 50, like when I hear these things, 100,000 by the age of 30, I'm very, very skeptical. I think, okay, it's just a bit of marketing there. And you don't know, do you?
Yeah, well, sometimes it comes down to just having a cracking business.
Cracking business that brings in a lot of revenue, that builds your portfolio, and you can market that. Anyone can say, I've got 10 properties by the age of 25, and people just believe it blindly, don't they? How do you know they've actually got that many properties?
Yeah, and they could have one thing that I've seen winds me up. So I know of a highly revered expert, for want of a better word, in the industry, and they have a large portfolio and they use that as their marketing. But the thing is, almost every past pick I've seen them make has underperformed the national growth rate. So how many dud investment properties can you have on a $100,000 income versus how many dud investment properties can you have on $1 million income? So if you have a very successful business, you can promote yourself as a property expert by simply pumping all your profit into your portfolio. And then it just becomes, this self-fulfilling machine. But, they're better at marketing themselves as experts rather than being experts.
I think my point here is don't be discouraged. Like a lot of people out there listening are thinking, like, I've still got a lot of debt. It's just the reality of it. Like, we've got debt, but there's nothing wrong with that as long as you can control that debt. And there's a high probability that you're going to carry debt in retirement, but that's okay because you're going to have a portfolio. Let's say your super, your properties, maybe some shares. Let's say that's all worth $5 million by the time you retire, and your debt's $500,000. Easy, you can wipe that debt out right away if you decide. But that's when you get closer to that 60, you want to talk to a financial planner to work out, okay, is it better for me to pay down my debt, or am I better off keeping that money in a sort of tax-free environment at that pension phase? So it's something that you need to work out, because if you pay down all your debt in your personal name, it means you're going to have more taxable income and you have to pay tax on that. So you have to find that nice balancing act going into retirement. Or the other option is, as you said, you sell. But if you sell, what happens? You lose that property. You want to hold it for the long term because it's growing. And then you also want to keep that rental income. Why would you sell if you don't have to? I would only sell if you're like, I want to retire, or I want to cut back to 2 to 3 days a week a lot earlier, and you need that money, then you might do it.
Right, so a lifestyle choice rather than
lifestyle
financial.
choice.
Yeah.
And you could build up your offset account, and then that might dwindle down. But like, let's say your surplus is $3,000 a month now, and I work, let's say 2 days a week, my surplus might be zero, but that's okay because I've got time back on my hands. So good episode. There's going to be a lot more on this in the future. You know, I'm really passionate about this stuff.
Yeah, and it sounds complicated, but people should just focus, for beginners, on cash flow management, shouldn't they?
My thing, cash flow management, as I said, the big thing for me is be careful of the whole, 30 properties by the age of 21 gurus.
Yeah, don't be discouraged by those.
Good episode, Jez. So where can listeners go for more resources?
Yeah, well, subscribe if you want more, and let us know if this is what you're interested in, because if we don't get any likes, we'll just stop, won't we?
That's right.
So let us know.
Yeah, in the comments section, you can make a note and like, subscribe, share to the world, and we really appreciate you taking the time. Thanks for tuning in, and we'll see you in the next episode. Bye for now, and take care.